Hello guys, and glad to have you on board again today. It's been a while since we last recorded an exercise video on the English version of these channels, so I thought it was really worth it to do it once again. The English community has very much been left behind, and I really wanted to change that in the future. As we head into the 2022-2023 season, these are the things that I'm willing to change. So we're not that many, and as we are all scattered across the globe with different time zones and stuff like that, it makes it even more complicated for us to gather in a live stream, which is not the case for French users. We're all in the same country. So in that perspective, rather than going for live streams, which we do, it's cool because we can be interactively talking to each other and asking real-time questions if some things are not understood or something. But I hardly can do the same for the English community. Still, that doesn't mean you guys have to be left over and just have absolutely no exercise sessions. So I'm going to change that, and I think right now, at least once a month, we're going to record those things. So I'm going to do it all on myself without anyone to interact with me, but still I'll do the same old thing that we do with the French guys. The thing is that these are the kinds of exercise you need to perform on your own, okay? So I'm just going to show you the example, and you do it on a recurring basis on your end. So this is more like showing how to do, but you have to do it as well. If you just look at me and say, okay, I think I get it. No, you have to practice. That's how things are learned. So here it is. What we do first is that you need to get you prepared correctly. So I'm making the assumption that right now you at least know what the indicators are. You know how to read them, meaning that when I will name each and every of the outputs of these indicators, you know what the hell I'm talking about. Otherwise, this is no point having you out there. Of course, remember that the strategy doesn't necessarily require the indicators themselves, but if you don't use them, then of course I need you to be able to translate the language of the indicators into corresponding manual plotting indicators. So when I talk about the context channel, you know that this is the channel that is built out of the latest current low points down to the current high point. Okay, you build your own channel yourself using parallel lines or whatever. Okay, so this is really what this is all about. Just be able to replicate the indicators outputs with manually plotted standard indicators like channels and stuff like that. Remember that when the context reverses, what you're going to be using is a pitchfork, which you're going to pull out of the latest two tops and the intermediate trough. So when you're looking at the pitchfork, that will be this. So if we reverse the trend channel, meaning that if from the latest two tops we tend to break, so here is where you would put the pitchfork as an example. Okay, so just be able to replicate the stuff. It's all documented already. So this is the assumption. Okay, so before we get started, I'm not going to take any time to detail whatever this output means or whatever. I'm just going to make raw analysis ASAP. And the second thing we need you to get ready with is the Prezi manual. Okay, so the Prezi can be gathered from the Discord channel. You're going to just quickly go into the Pro Indicators server. You're going to go into the educational content and look at the pinned messages. Okay, this is where you got all the necessary educational contents, including the interactive guide for Pro Indicator strategy named Prezi. Okay, so you've got the offline version you can download for Windows and Macs, which is a standalone version that in my sense can work offline, but I'm not 100% sure about it. Anyway, this is the online version which we're going to use today. You can just click on this and we will open that tab on your browser. So this is basically what we need to use, though I hope you're already familiar with this. Otherwise, this is like the Bible for the strategy where all the trading rules have been summarized in a single place. It's interactive, it's zooming in and out, it's very, very handy. So let's get it started with this, okay? First things is that we're not going to pay attention to chaotic markets, so that's the first things. If for whatever reason the random chart you're pulling up has chaotic candles or no candles at all because there's not enough volume or whatever, you just pass on this, okay? You don't try to give any rational sense to chaos. Excessive markets, which means multiple context boxes being unfolded, you really don't want to trade these either. So change the fucking time frame or pass to another asset, but never try to rationalize excessive market. Okay, so what we pay attention to in our set of analysis is to figure out if the market is in a trend or in a range, And if we do make that choice, what are the basics we do upon this? Because the strategy has absolutely no degree of freedom. Everything has been ruled in, so you just can't do whatever it is that you want to do. You're gonna have to do what your indicators tell you to do, okay? It's really that simple. No personal assumption in trading. That's basically the role of a strategy. The strategy is here to destroy every personal sense of feelings in the process of exposing capital. Okay, so that's what we're going to do, okay? We'll look at a chart, random chart. We're always going to start with randomly chosen letters on the computer. I'm just going to take my keyboard, set 2 letters, and I'm going to start analyzing the chart. I always start out of the daily chart time frame, which I also recommend you to do on your personal exercise sessions. Okay, and the simple question we try to answer is, are we in a fucking range or are we in a fucking trend, and how do we differentiate both? So let's get it started. The first asset we're going to start with, put it 2 random letters already, so we're going to start with this one. Daily chart is what I recommend you to do, and start analyzing this thing. The process is recurringly going to be the same over and over and over again, so just get used to it. Everyone is looking at charts from the left to right because that's what the human brain is conditioned to do due to your education or whatever. Everyone has already done that without you even mentioning or knowing it. You've already analyzed the overall thing, and you might say, well, this is a bullish trend. It seems to be rising more than falling. Okay, good. So remember what we said. This is exactly what we want to destroy. Even though that might be true or not true or whatever the fuck it is, we don't pay attention to your feelings. What you think about this price structure is not what we want you to do here. What we want you to do here is to gather derivative information, which is nothing that you want or created. It's something that is created aside from your personal feelings, and will tell you how strong, and if so, is a trend, okay? So this is really what we want. We want to use a set of rules based on derivative information, aka the indicators, or manually plot indicators. Remember, the strategy doesn't necessarily require you to use the indicators. What we want instead is that if you use the manual version, you need to know how to plot your channels and so on, okay? So when I talk about the context channel, you need to know how to build it yourself if you don't use the indicator. The indicator are not mandatory to learn the strategy. They're just a tool that build it automatically so that you don't have anything to do. Okay, so basically this is what it is. How do professionals read the market? They do exactly the opposite of what the retailers are doing. That doesn't mean the retailers are wrong, that just means the professionals do it better. So professionals always look at the latest information first, okay? We read from right to left. And most importantly, like 90% of the information will help us proceed by the latest approximate 5 context boxes. So this is the first assumption. Remember that I always look at the market in here first, and looking at the remaining, or at least the last 5 context boxes, okay? This is where most of the answers lie. So get there first instead of trying to read from left to right. So here are all the informations I need, and specifically the one that I need first. Am I in a trend or am I in a range? In order to assess that, I'm going to look at the moving average and the context, okay? So if the context is sitting above the moving average, meaning there's a distance between the two, the wider the distance, the stronger the trend. But it also means that trends are not there forever. We're going to have to assess trend maturities and so on. But this means, anyhow and anyway, we're going to be in a trend. Okay, so this is trending environment. So in our simple question, if the moving average is inside the context boxes, we're going to open up the range folder. If it's aside from the context boxes or away from the context channel, then in that perspective, we're going to open up the trend folder. Okay, so in here, like I said, very simple question. We don't have to look at the previous stuff, okay? We don't give a fuck about all this. All we know is that in here we're in a trend. So before proceeding any further than that, we open the trend and we validate the goddamn rules to make sure that we're looking at something that makes sense. So there are 2 conditions that we need to see in order to make sure that we're in the right time frame. We need to see that there is a preceding range before we broke out of the trend. We broke out in a trend, and we need to make sure that there is no trend on the higher time frame because we want to trade the larger trend. This is where the risk will be the lowest. So the first things we're going to do is that we're going to have to look at the higher time frame, and bang, we're in a trend in here as well. The moving average is below the rising context. So this is where the trend is. Might eventually even be higher than that. If we go to the monthly, no, it's not. In here, there's lack of history. We just have 2 context boxes. So we're going to go back to weekly. This is where we have the larger time frame in trend. We do the same thing. 5 latest context boxes, and don't try to read from left to right. In here, we've got the same old assumption, the rising moving average and the rising context, and we can see that the context is rising faster than the moving average actually, okay? We can even see that in here for this context boxes, they have been unfolded. Though remember that excessive markets will plot multiple of these. So if you see this happening over and over again, like multiple context boxes gets unfolded, you know that you deal with an excessive market. And in that perspective, don't try to go any way further than that, just change asset. I'm going to teach you how to assess those excessive markets later as you progress with the strategy, but try to make it easy on you on the beginning, okay? So in here, it seems like it is okay, because it isn't too much unfolded boxes one after the other. Looks like the trend is very strong. Like, remember, the distance between the two just tells you how strong the trend is. So the second question, now that we know that we have a trend, is how we proceeded by a mature range. Okay, so I'm going to scroll back in time, and when was the last time the moving average was in between the context and the context were oscillating from support to resistance? This is where it happened. Okay, so of course the indicator can't backplot, so just try to extend to the left the first context boxes. So did we range into this area? I would like to say yes. We could have been taking a bit more time, but here is our mature range. Okay, so we can answer all the questions. We know that this is the primary trend. Okay, so we're in the good thing. This is the primary trend structure. We've answered both of our questions. We're in the right time frame. So right now we know that we can open all of these subfolders trying to figure out which one it is. Though expert level required for the multi-time frame, so we're not going to do these ones anyway, okay? So we have only 2 choices left, the primary trend and the alternate structure. How do we differentiate that? That means you need to know both of them, and we need to know which one it is. Though clearly in here it's going to be a primary trend, though I'm not going to go into the details. You have to learn all of these things and the intermediate maturities. These are parts of the trending lessons. But that being said, we need to identify how mature we are in terms of advancement of that trend, okay? And for this, we'll look at price, moving average, and cycles, okay? So that's what we do, though I'm going to make a TLDR in here. If we need to figure out the maturity of that thing, then of course the range has been real quick, but in here we can see that there's a total absence of bearish cycle. There still lacks a bit of a breakout in here as well, but if we had to break that trend, I would say this is where the breakout occurred. This is where the bears totally failed to pull out any bearish cycle. We probably have a few sets of trend following opportunities in here, and the pullback maturity, which is the market succeeding to terminate a bear cycle and closing below 50% context, which have been done in here, and a mature range on the lower chart time frame, meaning that we have gone from trend channel boundaries to trend channel boundaries, is done. So we had a pullback which took the nature of a symmetric triangle, and don't give a fuck about the structure. It just assessed that we need to go from trend channel boundary to trend channel boundary multiple times, and we need to terminate a fucking cycle in here. We also need to retrace at least 23%, which has been done in here very clearly. And that's it. So we've got our pullback, and we know that every pullback is going to be broken to the upside until prices get to trade above or at least at the resistant context. And when we get there, this is where we find a final excess, meaning that the market will normally terminate its trend into its nearby area. So this was a first final excess. We had a signal in here, a price signal by this triangle in here, but as you can see, nothing too fancy occurred in here in terms of risk limitation. I mean, the momentum was still very strong, so I would suggest in here first partial profit taking would have been very wise. Eventually, closing above the resistant context would have been a red flag, like a good signal to get the hell out. So this would have been, in my personal opinion, the fly the fuck away from this market type of signal. So first, security taking profit. Second, because the market is accelerating and we know that it is not going to be the case, okay? We all know that when the trend is done, if you found the appropriate time frame, you should get the hell out of this market now. So you would say, then what is that, Phil? Can't you predict the market? No, I don't. What I can do instead is predict risk management. And what I can tell you for sure is that if you didn't take profit in here, this was stupid kind of risk limitation. Okay? So this market has built a trend. And now that we know this trend is over and is terminated here and here, now all we're left with is waiting for this one to neutralize and build a range, because after trends, the market range. Remember that trends move value from area A to another area B. So the value will never get back there, and we know that for sure because we've terminated a trend structure. Okay? So this is a price area in which we'll never go back. All right? Generally, when the trend is terminated, the market will range in between the prices that have been dealt as a low value in the pullback and the final excess. So you know that the current value area sits in between 23 and 55 or so. The market is very likely going to build a market top in here. And though the average median value for these tokens, these assets is going to be $40, that means now until further notice, you're going to trade this as a range, but you're going to have to wait for the range to materialize, meaning that the next best trade is to open up the strategy. And if we know what's next to come, then this is a range, okay? In the range, contexts might be rejected, and we might not be ranging on the higher time frame, okay? Which we're not, as we've seen. The monthly chart time frame doesn't have enough history for us to contextualize, and in the weekly chart time frame, we're gonna have to wait for the market to reject context. So if we do in here, and if the market reverses, we want it to go as low as the reverse, the opposite context, so that we have the second rule validated. And in that perspective, we'll have all that we need to consider that we are in a range. And if we are in a range, we're going to be able to open one of those two boxes. In a ranging context, the only question that matters is the range preceded by a trend? Okay? By trend, we don't necessarily mean the native trend. All we need is to have the moving average that have been below the context, and both of them have been rising. Okay? So in here, in our example, yes, of course, we've been preceded by a trend. The trend that we've currently analyzed and we've said is mature enough for this to get the hell out and wait for this trend to neutralize and build a range. We're just one step ahead. So what's next to come is in this one is not going to be a dumb range. It's going to be a third range bound. So what we want now is to see the context reversed, no price squeezes, and no squeezes on the higher time frame as well as a risk limitation. Okay? Though we really want to be patient, but if this one shows up, the only thing that's going to happen is either the third range boundary is going to be found and traded, or it's going to be squeezed, meaning that we're going to probably take a stop loss if we trade it, and the other one is eventually it's going to be late. So what it's going to look like is that, once again, these are contexts that you're going to have to learn, okay? And normally you should master these. So if we take this one as an example, okay? Basically, what we want first to get a range is that we need to reject the context. We need the market to stop trending, and in that perspective, we need to reverse this context. Once this context is reversed, we're gonna get a third range boundary, meaning that the market should do this and go back to the resistant context, where we'll find a tradable opportunity. The third range bound context. The third range bound context, okay, the range is preceded by a trend, the context have reversed, the price reaction, a confirmation triangle, and prices have not broken the first bound, okay? We don't trade if the price is at the double top area, okay? Then there are two types of third range boundaries. The neutral, which require you to be trading above the resistant context with at least 76% Fibonacci's, or the variant, which is a bit more aggressive, that allows you to trade inside the context, but this one requires a trend signal on the momentum. Okay, so these ones have a little bit more technical requirements to reduce the risk than the neutral version. Both can work, and you kind of have to learn these. Okay, it's not that complicated. It might sound like a lot of information to process at the first glimpse, but don't get me wrong, it is pretty damn simple, and the more you practice, the better you'll get at this. Okay, so this is really what this is all about. And of course, you're going to make sure that you're not in a late third range bound first. This pattern isn't that complicated. It's when the market goes from context to context, rebounds without reversing. You have to go at least to the trend channel, okay, and trade at least above it, okay, and then in a second and final stage, the market breaks the previous low point, this one, and reverses the context, okay, and these ones have to be happening in the same time. Okay, you must reverse the context as you break the low point and so on. When all of those conditions are met, you know that the third range boundary has already happened. It should have been there, and the only reason for this, if you read to the main cause, is the fact that there are some protections in the indicator to avoid too many times to reverse the context. And in here it just says the indicator decided not to reverse the context, but it probably should have. Okay, so the indicators will make mistakes, okay, but you don't need to understand too much of it. This is a security that I've built, meaning that, well, it saves your asses more than it will cost you anything. So you really want to understand that the worst case scenario is that you're going to miss a trade. Missing something in the market is not a problem. You're missing things every time. Like, you've just missed a trade right now. There was a tremendous opportunity and you've missed it. And gosh, there's another one now. Oh, and another one. So don't get me wrong. Missing things is not bad in trading. Doing bullshit instead very much is dangerous. Okay? So just try to follow the rules. If the third range boundary is late, meaning that the algorithm should have reversed the context earlier and did not, then just understand that it is still late for you to trade. Okay, so the only reason, so when you see a third range boundary context, the only thing you might want to pay attention to is to make sure that this wasn't a delayed third range boundary, because if it was, then just let it happen. You know that you've missed a trade, don't try to trade anymore, okay? But the next big trade to come from this asset is to take your fucking profits, if not already, for those who are trend trading, and for the others, wait for this to neutralize, and there's going to be a nice third range boundary. Is it going to be a bearish third range boundary, a trending third range boundary, or a neutral? I don't know. All I know is that you have all the information to process the price reaction as they will occur. Okay? It's really that simple. So today was just one example. We're going to take a second one and then call it done. So I'm going to go whatever JK. I suggest you use stock market for your examples. That would be better in my personal opinion. This is where you have lots of chances to find liquid assets. And we're going to go for Jinkos. Oh no, I know this one. I have it in portfolio. So I'm going to analyze something else. Just kitchen holding groups. Start with the daily chart. Okay, and do it there. Okay, so what we have is first we check that there's enough trades going on, like we do have candles that look rational enough. I'm going to say that one looks okay. So we're fine with this. Second thing, okay, is that we have a look at the latest 5 context boxes, okay, not the too much bullshit of it. So what we have in here is a moving average inside the resistant context. So this is not outside, so this can hardly be considered being a trend, okay? But this could eventually turn out to be, because the last context box has a moving average outside the context. So in here, we don't have a clear answer. It sounds like shaded gray areas. We just can't get a definite answer to this. It doesn't look like a trend in the beginning of our analysis, but it definitely looks like it is in the end. So we might be transitioning to trend, yes, or not. And in that perspective, this would be a trending range, meaning that this is just a range that has a directional move into this. So how do we differentiate that? Well, we're going to have to look and scroll back in time. We have an assumption. We can't give a definitive answer to our first question, so we're going to try shifting the odds one way or the others. So the difference is that we always take the least probable stuff and we try to pull it away, okay? So remember that now we just can't give a definitive answer to whether we are in a trend or in a range. So which one is the less likelier? most of the time we're going to be in ranges. So we're going to take the trend and we're going to see if it's valid or not. So if we're going to trend, remember, we need to be on the highest possible trending time frame and we need to see a preceding mature range, okay? So let's go back there. Though we can go weekly quickly, but as you can see, not enough history. We've seen that already. So on the daily chart, we're in the right time frame, okay? Can we see a preceding range? Meaning that the market has gone from context to context at least 3 to 4 times. 1, 2, 3, 4. Fine. Okay, even 4 and 5 times in here. So do we have a preceding mature range? Yes, we do. Okay. Do we have a breakout? I would say yes, we do. This is where the market seems like it broke out, even in here or in here. Actually, you have to make your eyes compatible with this, because if I were just to reverse that scale, you would definitely see the usual trend, okay? So make sure that your eyes are good enough to do the job in both directions. So in here, you would definitely say this is a bull trend because you got used to bullish trends more than bearish trends, but this one is in a clear downtrend, okay? So this market, we have now the answer, because the last context boxes told us, well, we don't know 100% sure, so we're going to have to scroll back in time to make that assumption a likely probability. And now we can answer this. We have all the prerequisite for a trend to be happening now. We can see the preceding range, we can see the breakout area, and we can see the trend. So right now, this market is going in intermediate maturity, meaning that there is no pullback. Remember, the pullback needs the cycle to terminate. So we're now in between the breakout. Okay, this happens in a sequence. Okay, this really is down, 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 down. Okay, so right now we can see the breakout, though we are currently going with the trend following. We might look for signs of divergences, which will give us the stop sign to don't trend follow anymore. And then we're going to get a pullback. So is this trend over? No, not at all. We still have pullback to go. So we're right now in between breakout and pullback, and we need to deal with those two contexts. So we need to know what the trend follow opportunity is, and we need to know what the divergence is, okay? So in here, what we have is a potential sign of divergence. The divergence is prices oscillating across the trend channel, but failing to actually make new lows in terms of momentum. So in here, yeah, the momentum still does plot the market. So it is more a matter of how much trend follow opportunities did we get. Though I'm not going to go into too many details in here, TLDR is that the trend follow opportunity has multiple patterns that are very, very easy to understand. The classical one is returning to the moving average 2 time frames below. So the order for you to trade that very quickly, if you don't want to change time frames, is to put a moving average, a 20-period moving average on this time frame, and that would be, no, I need the moving average bow. Okay. So this is what this is all about. I'm going to set these as default settings. Okay. No, I don't want any smoothing. God damn it. God damn it. This is crazy. Then 1. Okay. All right, so we got the 20-period moving average, and we can see that we had a first trend follow opportunity in here, and the second one was in here. So there's no more trend follow in this trend. Okay, the trend has broke out in here. It has validated and confirmed pretty much in here. This is where the trend follow opportunities happened. So first one, second one, and then we're done. So we already have made 2 trend follows. And now is not the appropriate time to try doing it anymore, okay? In that perspective, we're right now very likely headed into divergence, meaning this is the appropriate time to start looking on some gains. The market trying to accelerate to the downside with this cross signal just gives us the risk limitation we need. As the market tries to go down, it very likely will fail, so this is an appropriate time to start looking on some gains. Take your profits on some of your trend follow now. because you might be awaiting for a pullback. You know that the pullback is going to be another selling opportunity in this trend. So in that perspective, you know what the pullback is. We need to have a mature range, so we need to oscillate across the trend channel. We need to retrace at least 23%, and we need to close context boxes at least above the 50% context to make sure that the pullback has occurred. And we also need to terminate a bullish cycle. So right now is more about the bears have pushed quite significantly, and we're going to have some kind of a pullback form, which will be another opportunity to follow that downtrend. This is all you need to know. So your next speculative area is going to be the pullback. I think this is the next tradable signal. Okay, we're currently trading at the divergence maturity, meaning that for those who were trend trading to the downside, it's an appropriate time to start locking on some gains to get prepared for the pullback. You're probably going to reinvest those gains in the pullback, but the next tradable context in this market is this one. So learn about the metrics and all of the things that you might want to see in order to trade. You know that as well. The maximum risk will be 2%. You know where to put the stop losses and so on. Okay? So really, this is what this is all about. Okay? This is really that simple. So it is a lot of information to process, but once you got the overall scheme, the process, how do you get into trade with the strategy? By following the same old set of analysis and performed actions, then you always get the answer to what's next to do. Where am I now? What was the latest trade, if I have it or not? And what's the next trade? Where's the next technical risk limitation area, and so on? You can answer that question without ever introducing personal thoughts. Everything is lined up in a series of rules that you're gonna have to follow in order to find the answer. So you have no say in the answer. Of course, you still have your say in the balance of risks that you're going to take, because what, for example, in here we said the next trade is a pullback. That doesn't mean you have to take a 2% risk. You're going to have to gather the information when the pullback time frame, when the pullback context actually pulls itself into prices. And if it does, you still have choices. This is where you can make the difference as a human being. By gathering technical information, the tiny details which will orientate your risk management. Are you willing to take maximum risks or not? This is where you can personally grade and shade into the market, okay? Take some shaded grace decisions. You know that if you're willing to take the risk, you can go from 0.5% up to 2% risk. That's really what this is all about. Don't take any less than 0.5%, because in a way that means if you're taking no risks, then you're going to take no rewards. But also understand this, okay? You have lots of other metrics that the strategy gives you, okay? When you're trading in trending context, you know that your risk-reward ratio is generally going to be 3-to-1 up to 5-to-1. So you also know that when your trades in a trending context tend to provide 5 times the initial risks you've taken, might be appropriate to start logging in some gains, right? So you know these things that the strategy will tell you. So the more you practice, the more you get familiarized with how the strategy works and how the process of applying it to any goddamn charts, it's going to give you a lot more confidence into trading, because, well, you're no more than a human being, just like I am. And days by days, your mood will change. Some day you feel like you're the strongest, some other days you will feel very weak. You don't want your trading activity to do just the same. So remember that the only way around that is to have a definite set of smart rules. And the smart money doesn't have simple rules. Some people might let you believe it is, but it is absolute stupidity, okay? Professionals don't have a simple set of rules like if the price crossed the moving average band, whatever. No, bullshit. This is for the dumbs to talk about, okay? If rules were simple, we'd all be trading with automated strategies. And I know a lot of people who do, and they're not making money. So the reality is elsewhere. Don't be dumb enough to waste your time on simple strategies. Things are complex. They're not endless complex either, but you need to make it and balance these two things. If you have an extremely complex strategy that makes 10% a year, then maybe you should pay someone to get you 30%. If you have a very simple strategy that gives you 50, 60% a year, that means you're taking risks you don't know. And in that perspective, it means sooner or later the risk will come and pick you up. Okay? So try to find definitive balance. Okay? If you want to have good risk-reward ratios, That means you're taking risks, and those risks can't be simply managed with just a moving average crossing strategy bullshit. Okay, so it is complicated. My strategy is no better than other. It's just give you a glimpse of at least the bare minimum of knowledge it is for you to take on a 3-to-1 ratio. It requires you to know the ranging context, and it requires you to know the trending context, how to get yourself into the appropriate time frame, how to structure the trend with its intermediate maturities. You need to know the alternate trend structure, and so on. These things don't take too much time to learn. Out of the students that I have, either those that I have in my home that I teach trading each and every week for free, these guys take no more than a year to get this. So it's a 1-year-long study, and it doesn't take 7 hours a day to get there. It's really not so complicated. It just takes time, and most importantly, if you want to go fast, understand that it can't go any faster than 6 months to a year. But the only thing you can do to make it as fast as possible is to learn it the right way, meaning that there's a sequence for events. You must learn the strategy in a sequential order. Learn the range first, and then the things, and then the things. If you try to jiggle and mix up those things by starting with the most interesting context like trends in the beginning without ever trying to understand ranges first, if you want to get to the interesting things immediately, you will miss on all the early boring stuff that I need you to master before. So understand that there's a sequence to the strategy. You might want to go faster, but this is the easiest way to waste more time. Okay? The most efficient way to learn the strategy is the way I pulled it all together and follow the sequential order. That being said, I hope today's lesson was good. Don't worry, we're going to do a lot of these on a regular basis, finding random charts that I've never analyzed, and you'll see that the set of rules that I built works on every fucking chart. Okay? Bye, guys.